Hi, once again, this is Jason Trafford from Total Business Solutions, Tax and Accounting Services here in Phoenix. And this is the first part of a four-part series that I am doing to help benefit mainly self-employed individuals. This is the seminar that I do to help real estate agents, realtors, real estate professionals in the area help with their tax deductions and learn a little bit more about what their responsibilities are as a self-employed individual to the IRS. So I'm gonna put this on here because I have a lot of realtors that have been to a seminar or two but have missed a couple of things and would like to go over some parts again. So I'm going to split this into four parts because for a lot of people it is a lot to take in at all at once. So I'm going to split it into four parts, allow you to take each part and go from there. So that way you can review it as much as you want, and then if you had any other questions, you'll be given information to contact me, and we can go from there. But the first part of this series I want to go over is taking your vehicle and using it for a deduction. Now, for those of you that are now into the business of employing yourself or being a self-contracted individual, this is something you were not allowed to do before when you were just a regular employee, somebody who received a paycheck with tax withholdings on it, a W-2 at the end of the year from that respective employer. So this is kind of new to you because before, when you drove to work and back, it was a commute. Commuting is not deductible. So, and the same goes for a self-employed individual. Commuting is still not deductible, but your commute ends with your first business stop of the day. So, your first business stop of the day. So some of you realtors have a real estate office where you go to, you'll pick up your leads for the day, maybe meet a client, go on out and then show some homes. Well, your first business stop of the day, your commute, would be to that office. Now, your first business stop of the day does not necessarily have to be to the office. That first business stop of the day could be to a post office box, to pick up mail. It could be you're meeting a client somewhere for coffee at a local Starbucks or Coffee Bean, and then you go out to show homes. Your first business stop of the day could be your home office, which we'll get into in a different part. But anyways, you probably get the point. Your first business stop of the day is your commute. From there on, the mileage that you put towards your business then becomes deductible mileage. Now, mileage is always is always necessary to be recorded. It is a must. It's mandatory to be recorded because there are two ways of deducting your vehicle. You can only use one of the two ways, but no matter which way you use, keeping track of your mileage is the key through the whole thing. You will not convince an IRS agent that you get deductions, no matter how you deduct your vehicle, if you do not have your mileage recorded. So that is the key, most important thing. So the first way is simply the standard mileage rate. Standard mileage rate is issued every year, sometimes changes every year, issued by the IRS. Your tax professional, your accountant will already know this. And the mileage rate is something that we can't avoid. We put it into the computer, the software, and the software factors in the rate of mileage for using the standard mileage method. Now, at this particular time, it's 50 cents a mile. So it's pretty easy to use the numbers as I give examples, but 50 cents a mile being the standard mileage rate means that every mile you drive past that commute is deductible. So if you drive 100 miles in a single day, the deduction would be $50. So as you can see, especially with realtors that spend a lot of time on the road going from home to home to home, you have some clients that want to see 20 homes before they even put in an offer. And it can get a little monotonous, but know this, that if you're recording the mileage appropriately, at least you're getting some deductions for this. So there is, once you do make the money on that home, there is a deduction against that money because you used your vehicle the entire time. So keep that in mind. Record the mileage. Standard mileage rate is whatever it might be at this time. Like I said, at this rate, it is 50 cents a mile, and then it allows you to keep track of every single mile used. The other method is the actual expense method. Actual expenses, you still, like I said before, you still have to record mileage, but the actual expense method is there for you to use every single expense you put into the vehicle throughout the time, throughout the entire year. So this could be insurance, uh, your car payment, all the gas, any services or maintenance, oil changes, tires, rotation balance, things like that, changing your blinker fluid, whatever it might be, is deductible. And then if you own a vehicle, you are buying the vehicle to own, as opposed to a lease, you can depreciate the vehicle too. So vehicles have their own depreciation rates, and over time you separate the cost of the vehicle up, divided over the years of life that the IRS has set forth in their standards. Is that's how you depreciate. So you also get some depreciation value onto that deduction as well. If you lease a vehicle, you cannot depreciate. So that might be a little choice you make when you decide to purchase a vehicle for business, on whether you lease or buy. It's something that we take into account of whether you should lease or buy. Is if you're going to use the actual method for deducting your vehicle, depreciation is a good chunk of change that helps you get further deductions every year. Now, once you use the actual method, you can always switch from standard to actual method. But once you use the actual method, you cannot switch back to the standard method for the life of that particular vehicle. So when that vehicle dies, croaks, you trade it in, you get another vehicle, well, then you can go back using the standard method again. The reason why this becomes an important factor is because then we decide, if you have an expensive year, say for some reason you bought a lemon in its first year and the transmission was bad, you ended up having to fix the transmission out of pocket, ends up being a $3,000 job, and you just happen to have actual expenses into the vehicle that supersede your standard mileage deduction, you might be inclined to try to take actual expenses for that year. Now, if it was just a fluke year and you expect to drive more miles than put money into the vehicle, therefore your standard mileage method would be higher, you may not want to use the actual expense method, because if you use it for that year, you can't go back. Therefore, you could be missing out on deductions using the standard mileage rate year after year after year from there. So we always take that into account. What happens is vehicles end up getting less efficient, higher maintenance. They become more of an expense as the years of the vehicle start to pass. So what you may find out is that in the earlier years, when you're at your optimum fuel efficiency, the car's functioning on all cylinders and doing very well, you're not putting much into the vehicle. So the standard mileage method would be the best to use. But as time drags on and the car gets a little bit older, a little bit more wear and tear, your fuel efficiency goes down, therefore your gas price goes up. You're doing a lot more maintenance to the vehicle, so you're putting a lot of out-of-pocket money into the vehicle. You might see that your actual expenses will supersede your standard mileage rate. So you may want to switch to actual expenses. And since the vehicle is on its last leg anyways, you can always go back to standard mileage rate once you get a new vehicle. So that's kind of the things we take into account. So basically, the simplest way to put it all is that there are two ways to take your vehicle's deductions. One is the standard mileage method. The other one is the actual expense method. Standard mileage is exactly what it is. Whatever the IRS sets forth as the standard mileage rate is what you get to take. Actual expenses is everything you put into the vehicle. If you're owning the vehicle, depreciation is included. If you're leasing the vehicle, depreciation is not. And your business mileage is to be recorded. You want to record that every time you go anywhere, with where you started, where you ended up, and how many miles it was. And it starts after your very first business stop of the day. Your first business stop of the day is a commute. That business stop could be down the hall in your own home to your home office. That business stop could be at a local diner for coffee, that business stop could be at the very first house you show if you're a realtor. For those people who are not realtors, you kind of get the point. Your very first business stop of the day could be anything. So that is up to you. From there, if you have any other questions, you can email me at jason@totalbusinesssolutions.llc.com. Again, my name is Jason Trafford, and I'm the owner and operator of Total Business Solutions Tax and Accounting Services here in Phoenix. And my website is www.totalbusinesssolutions.llc.com. And if you have any other questions, there's a contact page on there. You can fill out your information. It goes directly to my email, and I can get back with you with any other questions. I'm always here. Have a great day, and I look forward to the next video series.